Hi there. Hi there. Lee Thurburn with livestreamlee.com. I want to welcome you to another episode. And this is I think the second or third episode where I've been able to sport my wonderful apricot rocket swag. You can see my, looks like a Star Trek person back in the background, doesn't it? So thank you for joining us today. Today we're going to be chatting with Dustin Miles. Dustin is, I've actually known Dustin for 25 years, but I only kind of briefly met him 25 years ago when I had a company called FlashNet and he worked there. In the intervening years, Dustin has gone on to do some quite incredible things. He is an engineer. I think he worked, we're going to find out, he worked for some aerospace company. I'm not sure, maybe General Dynamics or whatever they're called and nowadays. And he's gotten into the real estate business and he's become quite successful, done some really nice things with syndication. So we're going to visit with Dustin here in just a minute. Before we do, I want to just encourage you to go to livestreamlee.com. One of the things that we're committed to, actually my whole purpose in life, if you will, is to help small businesses grow faster. And if you go to livestreamlee.com and join the community, you're going to get an account, which is free, on the Apricot Rocket CRM system. And one of the things that we're going to do when you get that account set up is ask you about the services you offer. So please do that so we can know a little bit about you and then try to refer people to you. So those are one of the things that the Apricot Rocket system is all about. Now, Dustin Miles. I'm going to bring Dustin into the room in just a moment, but let me just tell you that if you want to get in touch with Dustin, you can go to momentummultifamily.com and learn all about him. So without further ado, I'm going to turn that off and bring Dustin in. Hey, Dustin, how you doing?
Hey, how's it going? Apparently I got the blue shirt memo.
Well, you did. It's Blue Shirt Friday. So
that's right.
It's good to see you again. You and I do some networking on a regular basis, and I always appreciate the opportunity to see you and visit with you. But Dustin, as we get this thing kind of going here today, why don't you start off by telling everybody? I mentioned FlashNet. Talk a little bit about Momentum Multifamily, and then also describe what you did in the intervening 20 years or so, because I know you did quite a few things.
So I guess, even before FlashNet, I've, always been pretty entrepreneurial. As a little kid, I had a candy business. I was 8 years old. I sold Blow Pops, Laffy Taffy, Jolly Ranchers, and I think that's it. But I profited about $50 a week. My bus driver called me the Candy Man. So, and then, sold. If there was a way for me to make money when I was a little kid, I was probably trying to do it: mow lawns, buy, sell baseball cards, all of the above. And then got into high school. It worked at FlashNet some, and then had went to UT Austin for mechanical engineering. While there, I had an internet business. It was, honestly, I don't know if I would have started that if I got very familiar and very comfortable with the internet just in general, because around that time frame, people didn't have no one had websites, very few people, and so I had started an e-commerce business, and I sold. It's not around today. I sold a lot of stuff on Yahoo auctions and eBay. And I sold Pokemon cards, which is funny that I wish I had a lot of that stuff. It'd probably be worth a lot right now. But, my entire apartment in college was, a corner of it was just Pokemon cards everywhere. And so my friends would, look in my room and kind of wonder, hey, everything okay with you? Do we need to talk about something? So, and then after college, started flipping houses and doing rentals and all that good stuff. And so did about half a dozen of those before I kind of realized, hey, this is good. Made some good money, but it was kind of difficult to scale. Not that you can't scale in single family. I know plenty of people who have, but it's just it was just tougher to scale. And so started looking at actually I looked at storage a little bit too, but looked at multifamily and met some other people that were in multifamily. And obviously there's we're in DFW. There's tons of apartments everywhere, and so started getting into multifamily. I invested passively in a few deals. My first deal is probably not too far from you. It's over in Wiley, and so kind of got into that and started putting deals together myself. So the first deal I bought it for 4.1 million and raised about 1.7 in equity. And I remember I was so nervous signing those loan docs, even though it's non-recourse loan, but still, it's a lot of money. And so anyways, I've done 11 of those to date, over, I think total value is over 120 million right now. And have raised about 30 million in equity over the past few years.
Well, that's quite remarkable. You're still a young guy, so you've obviously got a lot of time ahead of you. But I'm curious about your start in real estate. Now, did you join one of the many different local real estate investor groups and meet some people there that kind of mentored you? I mean, how did you decide? How did you get comfortable doing your first deal?
Yeah, there were two things. So I'm a big believer in if you're wanting to do something, you either partner with people or you hire a coach. And just kind of anything in my life. So I was wanting to learn how to swim laps so I could go do a triathlon. So I went and hired a coach. I'm trying to run a mile under 5 minutes, so I hired a coach that coaches other people on how to do that, and they can do it themselves. And then same thing with apartments. I joined a mentoring group, and then the main mentor there had left, and so I followed. He started his own group, so I went and joined his group. And and then at the same time, so I had a coach, but then also I partnered up with a friend of mine on the first deal, because there's nothing like you can have the coach and all that, but if someone's in the deal with you and they have skin in the game, they're gonna pay very, very close attention to what's going on. And so anyways, I kind of did both of those at the same time. And I'm just in general, probably because of my engineering background, or maybe that's just how I am, I'm always trying to hedge my risk, and that's what investing is in general. It's capital preservation, then obviously you want to make sure you grow it, but it's always, you're just trying to hedge your risk and so you come out on top.
So have you had any, now do you still have mentors, or have you now kind of graduated to the point where you're more self-sufficient?
Yeah, no, I guess more or less kind of graduated, but yeah, so I've kind of left some of those groups, and so kind of I wouldn't say on my own. Where I'm always networking with peers. A lot. I have a lot of friends that do the same thing. We're always talking. We're always on webinars. We're always learning. So it's a nonstop. It's constant. You're always just trying to get better, and so that's so we're I'm a big believer in the Jim Rome quote of you're the average of 5 people you hang around. And so hang around people that are kind of on a level up from where I'm at, and so that way it just kind of, it feels like it's a natural. If that's what the kind of talk you're used to hearing and people are at that level, in my opinion, you'll naturally kind of, gravitate towards that.
So what are some of the, I'm going to go out on a wild limb here and say that some of your deals have been better than others, and you probably have had some deals that were a little on the, touch and go, big learning curve sort of side of things. And that's kind of the typical way things go. So describe some of the process of how'd your deals go? Have all of them been super successful? Have you just, have you had any that have been tough?
It's all been rainbows and unicorns. That's it.
Oh,
I'm kidding.
Is that going to be the name of your book, Rainbows and
Yeah,
Unicorns?
right. Yeah. Yeah. If it has this rainbow and unicorn, maybe falling into the mud, but no, there's hiccups and everything with pretty much every deal I've been involved in. There's one that's been really, really smooth, but for the most part, there's always hiccups. We've had, a few years ago, we had Greece was in financial trouble. This was, I think, 2015. So they were causing interest rates to go bonkers. So we were underwriting at, which we felt was conservative. I don't remember the exact numbers, but we were underwriting an interest rate of about 4.5%. I think that, rates were around 4.25 or something like that. Well, with Greece and all that going nuts, those interest rates went from 4.25 shot up to 5.5. And, that 100 basis point, spread between, we underwrote to, 4.5 and it's at 5.5. That 100 basis point spread can really put a damper on your deal, and especially the cash flow. And so, thankfully it's called rate lock. We rate locked as it was going up. And so I rate locked at 5.05 before I think it ended up hitting about 5.5. So, we've had, I've had a tenant burn down the office. I've had, you always have, we've had loan proceeds cut, kind of last minute. We've had, just different things, and we've had, not to bring all that up, but we've had some really good successes. We've had some really nice exits for investors, even though there's been bumps along the way. So that's been good. We've had, fires. I mean, these are a lot of, especially in the past, it's been more workforce housing. And these are they're older properties and, tend to have, more maintenance and more, we're dealing with chillers and boilers and things like that, and 50-year-old pipe. And so things, tend to break. But overall, it's been very strong. I've invested in 2 deals in Oklahoma and 9 in Texas. All the Texas deals have done fairly well to date, and we struggled a little bit more in Oklahoma. Oklahoma just doesn't have the natural population growth and job growth, especially, DFW, Austin, and Houston have just been off the charts. So it's hard to compare. But so in our focus now is the Texas Triangle, DFW, Austin, San Antonio, and Houston, just because of all the growth that's happening there.
So what is now you began syndicating deals. Let me rephrase that. So you started off buying some properties, I'm guessing, pretty much solo. And then as you got some experience, when did you begin syndicating deals?
The first deal I syndicated was in 2014.
And at that point in time, how many properties had you purchased before that deal?
I just did a few single family. I did half a dozen single family by myself.
Okay. So the first deal that you syndicated, and for the benefit of folks that may not be familiar, syndication basically means
it's pooling funds together to go buy a large asset. So most people, so I mentioned the first deal where we put together roughly 1.7 million. So, some people have that much money. A lot of people do not. And so this is basically giving, I'd say, normal people, access to, these types of investments. And, so what we're doing, the average, I don't remember what the average investment was for that deal, but it was probably about 40,000. Our minimum was 25K. The average is probably about 40K as far as investment. And so we had some people, in the 6-figure range too. But it's all it is it's just pulling funds together and then going to buy these large assets. And the reason, the difference between doing that versus going to buy single family, because I bought single family, was, if you have, let's just say 2 houses, or maybe even 3. Let's say you have 3 houses, and let's say, one of them, goes vacant. Well, you're 66% occupied. You might be breaking even. You're probably not really cash flowing at all if you take into account all 3. Whereas with an apartment complex, 100-unit apartment complex, you have, let's say it's 95% occupied. It's 100 units, so it's 95. There's 95 people. And let's say 3 people move out. Well, you're only, you're 92% occupied at that point. You're still cash flowing. You're still considered stabilized. And then also with an apartment complex of that size, you can hire, a full-time maintenance guy. You can hire, full-time manager. And those are just things that you can't do on the single family side. You can hire a management company, but, by the time everything's kind of factored in, there's not a ton of cash flow. So, and then also when we're going to upgrade things, we get price breaks because we doing a bunch of doors. So instead of, on the 3 houses, you're buying 3 toilets, or I'm not 3 toilets. Let's say you're buying, it's 3-bedroom, 2 baths. So you're buying 6 toilets. Over on the 100-unit apartment complex, we're buying, probably closer to 200 toilets. And so we're going to get a lot better deal than the person on the single family. And we can hire a third-party management company. So it's a little more hands-off. The single family, it's, if you're not hiring a management company, it can be fairly hands-on, especially if you're here in Texas during the summer when ACs tend to go down. So, it's just, when we're buying an apartment complex, you're buying a business, and we're getting non-recourse financing. And non-recourse means that, so I have a lot of loans. None of those are, because they're non-recourse, there's no personal liability. They don't show up on my credit report. Whereas if I go, if you're buying a single family scale, you can do this. But if I go buy a single family, all of those are, it's recourse, and it shows up on my credit report.
So the first deal that you syndicated, I think you said it was about a $4 million deal, and you raised about 1.7 million. How long did you have that deal, and what kind of annualized return on investment, or what kind of X return did people get that got in on that one?
We owned it for between 4 and 5 years, and some of this is because of the real estate market in general has just gone up quite a bit. But we were pretty close to a 3x return net to investors on that deal.
So
like 2.95 or so.
That doesn't necessarily mean the property went up by a factor of 3, but it means that the equity growth for the investors meant they put in 10 grand, they got back about 30, or do they get back about 40? They got back about 30?
Yep.
Okay, well, that's a heck of a deal, and that's all because of the leverage, right?
Yep.
And it would be tough to do that on individual deals. Okay, so how many deals have you syndicated now in this new career that you've got?
I've syndicated a total of 11, and we've sold 6 of them.
Okay, so you've turned 6 of them.
Mm-hmm.
Do you have any kind of average return for the investors? Do you that you can give us for the 6 that you've done?
Yeah, it's been about 2x return, and again, I mean, part of that, the market's gone up a lot, so we're the kind of the the returns that we're projecting on newer deals going forward, we're pulling back, from that. Just it's it's called cap rate compression. So you gets a little complicated, but anyways, it basically the lower the cap rate. So if a cap rate's at 4, that means that there's a lot of demand for the property. If the cap rate's at 8, there's not as much demand. So we've had cap rate compression, which means there's been more demand. So it's gone. Properties in DFW went from between an 8 to 10 around 2010, 11, 12, and now we're down. Most of the cap rates for most deals are around a 4 to 5.
Right. So the lower the cap rate, the higher the demand. You're competing with more people, so you're not getting as much of a return projected.
Yep.
Is kind of basically the way it works. Okay. So what is your parameter for trying to do a deal? In other words, when you find a property that you like, what is your target? You want to try to turn it on an average in 5 years and get a 1.5x or a 2x in 5 years? I mean, what are the kinds of things that you use as global parameters for the properties you're searching for?
So we do the parameters we're looking for as far as returns. We're looking for around a 1.7 to 1.8x return is what we're looking for. But really, even before we look at the numbers at all, we're looking at the location, because you can put a lot of money into a property, but you can't change the location. You can't change who your neighbors are. You can't change, the schools. You can't change a lot of things. And so we put a lot of attention on that area. We want to make sure we're very, really comfortable with the area before we, honestly, before we even really start digging in. We're trying to make sure, look at the schools, what does the crime look like? What's the household income? How much how much are the homes nearby? Is it cheaper just to go rent a house down the street than to go rent this apartment? So those are all things we're looking at.
So I'm presuming, like most people in the real estate world, that as time has gone on, the size of your deals has gotten larger. Is that a fair statement?
Yes.
Where are you at now? What size deals are you currently doing? What's your most recent deal, and what are you looking at? What are your sort of deal parameters that you're looking at for the next couple of deals that you've got in mind?
So the deals we're looking at are between our parameters between 20 million and about 50 million. The deal we just closed was close to 30 million and put together about 10 million in equity. So that's kind of that ballpark we're looking at. We're also looking at newer deals, so kind of 1980s and up. There's a few reasons for that. And our preference is a little bit on the like 90s and 2000s would be even better. And the reason why is because whether you buy a newer deal, or an older deal, the return right now is basically the same. And so whether it was built in the 2000s, the 80s, or the 60s or 70s, the cap rate is all about the same. It's between about 4.5 and a 5. And so in our minds, if the return's about the same, let's go buy newer. There's less risk involved there. You don't have the building's not as old, the plumbing's not as old, the roof's not as old. And then, typically the newer product, it's going to be in an area that is typically growing as well.
So you mentioned that your return that you're kind of targeting now is in the 1.7 to 1.9 return. I don't remember hearing you say over what length of time. Is that a 3-year, 5-year, 10-year? What are you kind of looking at the horizon?
Yeah, our projections are in that 5 to 6, 7 year horizon. Okay. So that's most people are underwriting between 5 and 7 years. I've seen some people at 10, but most people are in that 5 to 7.
So somebody that wants to get into real estate and get into commercial properties, they have the choices they have would be to join somebody like you and be one of the investors, in the syndication that you're doing. Or what other options are there? I mean, are there any other options other than just going out and doing your own deals?
Yeah, so I mean, they can invest passively with someone like me. There are some crowdfunding websites where they can go invest passively, but it's just however people want to play it. But they generally they don't get to necessarily meet whoever they're investing with, and I don't know. I like to meet who I'm investing with, so that's maybe it's personal preference, but but yeah, there's, or they could go out and buy some single family, or they could try to do multifamily. Multifamily is pretty tough. There's a syndicator in DFW that he calls it an unfair game. And, because once you kind of get into it and you've done some deals and all that, it's just, that learning curve for that first deal is pretty darn steep. And so I would say if you are going to really, really want to do your first deal and all that, just where you're either buying it yourself or putting money together, I'd probably try and partner or hire a coach and kind of go from there. But there's a lot of people. I mean, that's what I did. I invested passively with some other people that I met, and I learned from that. And so that's something if it works for people and they have the capital, that might be a good way to go, is go invest with some people passively, kind of see how it's done, and then go from there.
So we're going to run out of time in a couple of minutes, but I'd like to. What is the when is your? I know you just closed sometime since the first of the year, like in either January or February, on a really good sized property. I think it's called the Henry down in Houston.
Yep.
Have you found your next one yet?
We have not. We've made some offers and all that. A lot of the deals are starting to come out right now, and so we're evaluating quite a few deals. We were down there last week. We were kicking off some projects at the property, and then we were also looking at some new deals as well.
Okay, so if somebody, looking forward, and of course, since you don't have a deal, you can't say exactly when, but your plan for this year, and of course, we still have, 8 or 9 months left. Your plan for this year is to do 1, 2, 3 more deals this year?
Yeah, we'd like to do a couple more, trying to hit, between 2 and 3 more, but somewhere in there. But yeah, we're out there looking, and we're looking in, as I mentioned, DFW, Houston, and Austin, San Antonio.
All right. Well, so the best way for people to get in touch with you, what would it be? Connect with you on LinkedIn, go to your website.
Feel free to add me on LinkedIn. You can go to momentummultifamily.com. My email is just dustin@momentummultifamily.com.
I'm going to put that up there, Dustin. I actually should have had that ready to go before, but here we go.
Yeah,
Dustin.
Yep. But yeah, feel free to reach out to me. I'm happy to help any way I can. I mean, frankly, there's a lot of people that helped me, and, happy to, help, pay it forward and all that. So if there's anything I can do to help, feel free to reach out, and we can hop on a phone call, Zoom call, and go from there.
Dustin, thanks for your time today, folks. Again, I've known Dustin for a long time, and I also know his reputation. He's a good guy, and if you're thinking about or looking for this kind of investment, give Dustin a call, have a conversation with him. There's a lot of good people that trust Dustin, and I think you could be one. If you're, he'd be a good guy to go with. Dustin, again, thank you for your time. I will see you on Monday.
All right. Sounds good. Thank you for everything.
Cheers.
Lee.
Bye-bye.
See ya. Bye.
Folks, my last comment here is, let me go ahead and remove, let Dustin go rather than keeping him hanging there. I'm going to put up the live stream Lee again. Be sure and go to livestreamlee.com and click on the Join My Community link. Get yourself an account. We have a lot of good content there, as well as, again, if you are in business, we're going to try to help you connect to some, some people that are looking for you. So thanks for tuning in. We'll see you on Monday at 3 o'clock, where we're going to be continuing our conversation about how to build a cash flow projection spreadsheet for your business plan or private placement memorandum. So if you would like to see how to do that, join us at 3 o'clock on Monday. Thanks for joining us today. Bye.